The first half of the session will be a panel discussion with our expert panel who is joining us today from the capital market industry, followed by a Q&A session with the audience. If you have any questions, please feel free to choose or log in via sli.do to raise your questions, or Slido to raise your questions. And also, I would kindly request everyone to mute your mics to make the process smoother. And to start off with, first and foremost, let me introduce our expert panelists who are joining in on today's session. We have Alistair Correa, Director and Portfolio Manager of Orient Fund Management, joining us with us today. And we have Chetana Allapola, Director Research at Equity Stockbrokers, and Vindhya Jayasekara, Vice President at NDP Wealth Management, joining us today. Good evening, everyone.
Good evening.
Hi, good evening.
To start off things, let me just give a brief overview in terms of what has happened during the last couple of weeks in terms of the local domestic equity and fixed income markets. So as we all know, the COVID-19 situation has changed the entire landscape of almost every country in the world. And with economic activity coming to almost a standstill situation, there have been concerns of prolonged economic recession, which has prompted central banks and governments to infuse unprecedented amounts of liquidity and fiscal stimulus to promote or to provide the easing necessary to ease the economic situation. And as you all know that we've seen a lot of unprecedented volatility in global markets, from equity to commodity prices, and also in terms of fixed income markets where yields have reacted to the central bank actions and as well as the economic repercussions the systems will face. So Sri Lanka has not been different to all this. And if you look at the slides here, the Sri Lankan markets the equity market as at 20th March was down by about 25% for the year. Some of the markets which operated post 20th March saw a slight recovery in terms of market activity and recovery in terms of share performance. But given the closure, we've been at 25% down year to date. We've seen a foreign sell-off of about 5 billion rupees year to date on the equity market. While from a bond market perspective, in terms of government securities, we've seen the rates coming down with T-bill rates falling by about 150 basis points. We've seen the secondary market bond rates also falling by about 100 basis points over the course of the last 2 to 3 weeks. And in terms of the projections coming out in terms of GDP growth, the Central Bank of Sri Lanka yesterday announced that they are looking at GDP growth of about 1.5% for 2020, while most predictions for GDP growth for Sri Lanka are more tilted towards negative than in terms of negative growth. So in light of the gloomy economic conditions, we saw the central bank cutting down on its policy rates twice during the year. The statutory reserve ratio was cut down by 100 basis points over the last 3 weeks. And we saw the bank rates, the rate at which banks borrow from the central bank, being slashed by 500 basis points to 10%. And in addition to this, we saw the Central Bank of Sri Lanka printing money or increasing their government bond holdings. They printed roughly about 300 billion rupees over the last 2 months. So this has provided the required liquidity into the system. And with the liquidity being infused, we've seen the central bank and the government also imposing restrictions on imports, with a lot of pressure being exerted on the currency. And in terms of currency, we've seen a 6% year-to-date depreciation up to now. So that's where we stand in terms of, to give you a brief outlook in terms of where we stand in terms of the local equity and debt market. So I'll start off with the panel discussion with questions on the domestic equity and fixed income markets. My first question is to Vindhya. Vindhya, with regards to the equity market, we all know that the equity market has taken a beating, with the market coming down by about 25%. But with regards to the fixed income markets, in terms of, if you look at fixed income as an asset class, how have the different fixed income segments reacted to the impact of COVID-19?
Hi, Odishan. Yeah, thanks. So in terms of fixed income, let me just divide it in broadly into two. Let's look at government securities first, and then I'll talk a little bit about corporate debt as well. Government securities, like you just showed us, actually rates came down. And this is a little counterintuitive to our thinking, because you would think with COVID-19, the negative economic impact and the shocks that are coming in, you would assume that the risk premium should increase and therefore interest rates should increase. But from the beginning of the year, you've seen that central bank has been implementing easy monetary policies. And this hasn't changed, this stance hasn't changed because of COVID-19. Earlier in the year, central bank implemented these monetary policies to make sure that to stimulate the economy. Now they are implementing these monetary policies, are aggressively implementing it to soften the blow. Right? So with this, we've seen that bond markets have really performed well. Market rates have come down, as you showed us. The one-year rates have come down from about 8.45 at the beginning of the year to about 7% right now. And the 10-year bond has come down from about 10.2% to about just around 9%. So we are seeing that with these interest rates coming down, bond markets are doing extremely well, and bond investors have made substantial gains in the course of it. The story is a little different in terms of US dollar bonds. US dollar bonds have actually, we've seen the risk premium that we've been talking about, the justified risk premium, being reflected in our US dollar bond segment. So we've seen US dollar bonds in terms of our sovereigns, which have started the year at around 4%. The immediate maturity is right now trading at about 35%. So bond investors in the US dollar segment has really lost out in terms of the fact that risk premiums have been reflected in the US dollar bonds versus the government bonds in terms of LKR denominated bonds. We've seen that interest rates have come down because of monetary policy easing measures. In terms of corporate debt, so obviously with local interest rates coming down, corporate debt rates have also started to come down and started to adjust. But I think what you will see now is a big disparity, Udishan, because you see, although government wants to bring rates down and they've made active measures in terms of trying to bring down interest rates, or central bank has taken active measures in trying to bring down interest rates and control interest rates in terms of banks and finance companies, the riskiness that investors perceive of these institutions go up. So the investors' required return will be different from what the institutions can offer. And in terms of CPs, in terms of securitizations, or any of these other instruments that are there in the markets, you see that there will be a disparity between what the investors want and what the institutions want to give.
Thank you, Inda. Similar to your view on fixed income, my next question would be over to Chetana. Chetana, despite the overall slowdown that we've seen in the global equity markets, we've seen certain sectors in global equities actually coming out as a surprise. We've seen companies like Zoom, which have really done well over the last 2 months, and certain segments of the equity market has proven to be resilient amidst the overall downturn. In a similar scenario, do you see any particular sector in Sri Lanka which could really outperform the market, or even remain resilient, or recover faster than expected in the current economic context?
Thanks, Udishan. So I think that the question has to be looked at both at a sector level and at a company level, right? And I want to sort of disclaim that by saying, for the next 1.5 years, I think we can expect a broad-based decline in earnings for most companies. So when I say these things, I'm talking in relative terms. So if you look at some of the sectors that could potentially perform, relatively better. Defensive sectors such as healthcare and telcos, where consumer demand tends to be quite sticky, I would think that those are some of the sectors that would benefit, in the slightly more medium term. Similarly, if you look at historically, which sectors in the Sri Lankan economy have actually performed post economic crisis, because obviously we can expect quite a substantial economic fallout in the next few months. Historically, the banks and the diversifieds have tended to sort of do okay once the recovery happens, and banks have tended to outperform even diversifieds once that recovery kind of happens. At a company level, I think the key thing to really look at is, how agile are they and how quickly have they adopted technology? You used an example of Zoom. We don't really have, that kind of, for example, PicMe, which could have maybe benefited from the current scenario. That's not a listed stock, so we don't really have that kind of, that sector is really not, we are not exposed to that sector, right? But those companies that have, the technology and the IT, so for example, banks, which were anyway sort of on more sort of digital platform and sort of shifting to that digital space, those are the kind of companies that might do well. Another sector that, another company or certain, like if you look at manufacturing companies, which manufacturing companies might do okay, those ones that have sort of more agility in their manufacturing processes can possibly, benefit over this more medium term. So I'll give you a quick example. If you look at apparel, most of the big apparel players have sort of quickly shifted to creating personal protective equipment, right? So that kind of agility where you have the ability to quickly adapt to the surrounding economic conditions at an individual company level, those are the companies that you should be looking at.
Great. Thanks for that insight on the sectors to look at. Similarly, if I were to raise a question to Alastair, Chetana was looking at counters which would do well in this particular kind of economic context. What company or what sectors do you think will be more vulnerable in terms of the impact, in terms of seeing negative impact, or might take a longer period of time to recover in the current economic context?
Hi, Udishan. So I think the obvious casualty is tourism, and in that too, the hotels. Very capex heavy, high operating leverage, and quite a bit of debt on their books. And at this point, given that you don't know how long this will last, I think one of their biggest challenges, even if they can not that they can tide over, but one of the biggest challenges would be how do you retain staff after a given point? And once you dismantle that, if that is gone, trying to put that back together when things are normal can be quite tough. But apart from that, anything in the Sri Lankan context, anything to do where we are reliant on imports, let's say consumer durables, white goods, non-essential FMCG, all of that will have it tough because of the controls that have come in. So even the banking sector, now that's the backbone of an economy. And even when things go tough, you'll have various policy measures that come in to help it. And it tends to recover. I think like Vinja said, it tends to recover faster once you come out of something. But here again, I think in the next 6 to 12 months, it'll be crucial how policymakers decide how they react to this, right? And it will be tough. And so we've seen a lot of measures that they have brought in to help the borrowers and ease the anxiety in the market. And I think there are lots of policies on the table where they also help out the banks and the other finance companies. But those maybe also need to be communicated better into the markets that so that sector is also kept, that the financial sector is helped throughout this.
Yes, talking a little bit more on the banking sector, Alistair, and banks account for about 25 to 27% of the market cap. What do you think out of the proposals which have come in? Say, for example, there's been a 50 billion working capital concessionary loan facility which has been given to the banks, and there's been a debt moratorium which has been handed over to corporate borrowers as well as personal borrowers. Which aspects of the concessions or any changes that the central bank has done towards the banking sector going to have a big impact on the banking sector overall? Is there anything material which will have an impact on earnings in terms of the banking sector?
I think in the short run, it will be material, because if you look at some of these, even the moratorium, how the banks can handle it. Who bears the burden of delaying these payments out? Some of that support, the burden is being borne by the banks and the financial sector. So that, I think in the short term, that it will have an impact. Do they come out of it strongly, or how, once things recover, is this one of the first sectors to come out of it? I think that's based on past experiences, it has been one of the most resilient sectors, and it comes out because it is crucial for the economy as well. And so even here, I think it's too early to say. As it stands, I think we've seen, like I said, the central bank, if you look at all their the measures they've taken, that it's what we can see is what's been targeted at the borrowers and how you can ease the burden on the market. But if I was listening to, I think Mr. Fernando this afternoon, and I think she was quite clear that it's taken for granted that on the other side, on the liability side also, that they are fully behind it. Maybe it needs to be communicated more out there, because if not, there's anxiety amongst depositors, because every time they see these measures being given out saying, okay, the borrowers are given this benefit or that moratorium, it creates a little bit of anxiety at the depositor level. So I think if that also can be, there needs to be better communication on how they are handling that side as well.
Thanks, Alistair. Chetana, if I were to ask you the same question in terms of what kind of impact the banking sector overall will see because of this whole pandemic?
Right. Obviously, the operating environment for banks is going to become even more challenging. Even before COVID-19 impacted the markets, banks were actually facing quite a bit of pressures. For example, their NIMs had come down to about to an average of about 4% for the listed banks. The NPLs had gone up to one of the highest values that they've had since the 2013 pawning crisis, and even since the 2009 global financial crisis. So really, banks were, they were operating in a difficult environment, and COVID-19 had just sort of worsened the operating environment for the banks for the next 12 to 18 months, I would think. Having said that, of course, their liquidity buffers are fairly strong. Right, there is a lot of liquidity in the system, partly because of some of the central bank activities some of the regulations that they implemented, and also because credit demand is weak. The liquidity buffers of the banking sector are quite strong. So if I were to put it in a nutshell, I agree with Alistair. Obviously, the next 12 to 18 months for the banking sector is going to be difficult. But again, what we do know from what has happened historically, once the economy does tend to bounce back, one of the first sectors to recover from that is the banking sector. So if you have a long-term portfolio, and again, this is only if you have a fully long-term equity portfolio, then looking at banks would not be necessarily a bad thing.
Thank you. Vindhya, this question is over to you. And talking about the banking sector, over the last couple of years, foreigners have been, as we spoke about before, foreigners have been large investor component of banks. And the bigger question among foreign investors right now is that with the surge in terms of fiscal deficit, which will come through with the escalated spending and the fall in revenues, and the extended and the large dollar debt repayments, which are for maturity by the end of the year, what kind of external borrowing pressures do you see from your perspective, and what kind of implications will these borrowing pressures have on the domestic interest rates and exchange rates?
Right. So in terms of external borrowings, I mean, we have one coming up in October. We have $1 billion in terms of our sovereign bond that's coming up in October. And even next July, again, we have another $1 billion coming up. Overall, this year, next year, and over the next about 5 years, I think we have a 4.2 to 4.5 billion each of US dollar repayments coming up every year. So in that sense, definitely we are at a difficult juncture at this point, especially given, like you say, the fiscal deficit, plus the fact that in terms of our exports are also going to soften and so on and so forth. So external borrowing, I think, is going to be difficult, given also the fact that right now ratings, we have been downgraded by Fitch. We are on a ratings watch by Moody's. So external borrowings in terms of commercial external borrowings is going to be difficult. But on the flip side, we have applied, for example, we've applied because of this COVID-19, there are other multilateral and bilateral loans that we are looking at quite aggressively. We've applied for the IMF 800 billion facility. We're looking at a 400 million and a 1.5 billion swap facility from China and from India. So with all of these, I think this year we will be able to manage the year. So like I was saying, central bank is quite keen on maintaining interest rates, and you were asking about interest rates. So I think in terms of keeping interest rates low, because we will be able to manage this year, we should be okay. Also, given the fact that private sector credit growth is also going to be soft. No matter how much interest rates come down, I don't think this is the time people are going to be looking to borrow and expand. They're going to be looking to maintain, sustain. So in that sense, I don't see a big pickup in private sector credit growth. I think the February numbers are the ones that are out last, and that's about a 4.8% growth. And these numbers are going to drastically come down over the next number of months. So with all of that, I think we should be able to manage interest rates till the end of the year. What happens after going forward, I think will be something when we move on to next year. I think it will be an uphill battle trying to maintain rates at these levels. On the one side, I think central bank will still be keen to maintain rates low to stimulate economic growth, but these are going to be major problems in terms of the managing the fiscal deficit in terms of keeping rates low. On the exchange rate side, I mean, Sri Lanka has always been a net import economy, right? If we look at last year, we've imported $20 billion US worth of goods. We've exported 12 billion. We run a trade deficit of 8. And if you look at our export numbers, of that 20 billion, about 5 billion comes from apparel exports. And apparel exports are going to be hit this year. So in that sense, our exports are going to come down. Other income earning sources like tourism sector is not going to do well. That was last year about 3.5 billion, as well as worker remittances, which were about 6.7 billion last year, is going to come down as well. So I think we are going to face bigger problems in terms of our current account deficit, trade deficit, and so on. The only saving grace that will soften this blow a little bit is one, the oil prices have come down significantly. So if you look at, say, 2019, end of 2019, oil was around $65, right? Somewhere in the mid 60s a barrel. Now it's much, much lower. We saw oil turn negative at one point, right? So we are seeing oil bill coming down from, I think it was about 4 billion, and that this bill will drastically reduce. Also, government has taken measures in terms of, at least in the short term, for the next 3 months, there are certain import restrictions that are there. And we'll have to see after 3 months what the government will do going forward. But both of these will soften the blow a little bit. But I think in terms of exchange rates, we are going to see much more depreciation than the usual 4 to 5% that we've seen in the past.
Alistair, you have anything to add on the interest rate and exchange rate front in terms of how the current scenario will pan in terms of affect our local domestic rates and exchange rates?
I agree with Vindhya. I think in the short run, and maybe a little longer than the short run, I feel interest rates will be soft. Even though there will be higher deficits and maybe money printing, that does not necessarily translate to high interest rates, I think, for a while. Now, caveat to this is we'll also have to go in and negotiate with probably some of these multilateral agencies. And at that time, it depends what type of restrictions or what type of conditions that come in. But there again, if you look at how they have, if you look at how they have sort of worked in the last couple of years, post 2008, they've been cautious about forcing too much of austerity. They know they need to you need to allow the market to grow and expand. So therefore, again, I feel even if you have to work with them, I think on the interest rate side, it will be we'll have we can expect a lower interest rate environment for a while. On the exports, yeah, so you're getting hit on two crucial sectors. That's actually three: remittances, exports, as well as exports, mainly apparels. On some of the other exports, I think we might do better, but they're relatively small. They can't contribute much. And tourism. Now, that's looking tough. So I think which is why you're seeing the draconian steps taken to control imports and manage, tide over this period. The only thing that I would also say is maybe just taking a couple of steps back. COVID hit us. It came on very fast, and people realized how fast it can spread. And you're beginning to learn how to manage this. It's still fairly new. You don't know, and the same way you don't know how long it will take. Now I know everyone's saying the end game would be a vaccine, but you might also see say a decent therapy comes up which can handle treatment better. Where this whole thing of saying, okay, we're looking at 18 months or 24 months or whatever might get shortened out. So in which case, I think we might be able to manage and come out of it.
Okay. Thanks, Alistair. If I were to touch on the same topic, Chetana, so Alistair was talking about a potential vaccine which could change the entire scenario right now. From your perspective, what do you think is going to be the turning point for the equity market? Is it going to be the discovery of vaccine, or is there something else which could suddenly turn around markets in the current context?
Sorry, Dishan, sorry, just to this thing, it is not a vaccine. I think a vaccine is probably going to take, its time, it's 12 to 18 months at minimum. I was referring to some sort of a therapy that helps treatment. So what it will do is reduce the time for recovery and maybe reduce the mortality rates.
Understand. Chetana, your views on what could turn around equity markets?
Right, for the Sri Lankan equities, right? So if you look at what has happened with global markets, right, like since the COVID-19 pandemic has really sort of panned out, we know that markets across the world on average have dropped about 30%, right? So when we look at, and you showed those numbers at the beginning also, year to date, the Sri Lankan equity market has dropped about 25%. If you look at it just from when it was declared a global pandemic to the last day of trading, which was on the 20th of March, that drop itself is 22%, right? So I would say that at minimum, we have once the curfew is lifted and markets resume trading, at minimum we have at least another 10 to 12% drop going to happen, right? Because Sri Lankan markets and the investors also need to fully price in the impact of COVID-19. Now, the reason I say it's minimum actually is because if you look at what the largest, drop in the ASPI in all its history was a 41% drop, which happened following the global financial crisis. Right? And we do know that the economic fallout from the COVID-19 is going to be far more substantial than the economic fallout from the global financial crisis, not just for Sri Lanka, but for the world. right? And so those are scary numbers, right? And so that's why I'm sort of saying, you know, a 30% drop for the Sri Lankan equity market in the near term is at the minimum point. What we've also seen in the global market is that there has been a slight recovery since that trough, about 30% drop trough. There has been a recovery in some of these markets because governments and federal and central banks have come in and quite aggressively stimulated the economy. And the Sri Lankan government and the central bank has also, you know, tried to sort of do some of the measures you spoke about before. Those are all sort of measures aimed at stimulating the economy, right? But what we have to remember is that our resource, I mean, our hands are tied. The government of Sri Lanka's hands are tied insofar as that we already have some existing macroeconomic pressures that we inherited way before the COVID-19 crisis hit, right? So I don't think that in the immediate future, we're going to see a sort of recovery, right? In terms of the vaccine, there again, I think, okay, obviously, once the vaccine comes, which is realistically not going to happen until sometime early or mid of next year, 2021, basically, you might see a temporary pickup in the market at that point. But really, for a sustained recovery in the Sri Lankan equity market, it comes back down to how we handle some of the existing macroeconomic issues that we have, right? Now, and you know, really particularly at that stage, when the risk appetite for emerging and frontier market assets comes back, at that stage, it's really important that Sri Lanka's macro economic fundamentals are strong, because at that stage, investors are going to start looking at, you know, which countries have the most strong macro fundamentals and strong balance sheets. So in terms of turning points, if I had to put it in a nutshell, I would say that really, you know, apart from the volatility and the little upticks that you see here and there due to developments around the COVID-19 pandemic, I think a long-term sustained pickup will only happen once we address some of our macroeconomic issues.
Right. Alistair, this question is over to you. So we are looking at a volatile period, more economic slowdown, kind of, as Chetana pointed out. There might be a further fallout before we see a recovery cycle. From your perspective, now we'll see companies actually transforming themselves to suit the current economic context, where they're changing their business models to meet the current requirements and changing customer dynamics. From a capital market perspective, how do you think the capital markets are going to evolve in a post-COVID kind of environment? And what do you think the new norm is going to be for capital markets?
Okay, so when you're talking about capital markets, I think we'll have to look at a bigger segment than it's sort of the whole system, as opposed to just the stock market. What you're going to see is, I think, on the like Chetana pointed out, I think the prognosis for the stock market, or as to when sentiment improves, is probably going to take some time, right? So then I think so what would drive activity? And I think given that prices have come off, given that some of these valuations and prices have come out a lot, and some of these companies might actually have to go into some sort of restructuring, you know, refocusing. An area that you probably see some activity increasing is in, you know, disposals, acquisitions, and mergers. Now, again, if I look at the narrow segment of the stock market, most of our companies are, you know, it's 51% owned by somebody. The majority, it's not diverse. So hostile takeovers are not easy, or it's almost impossible, right? But you might have a scenario now where the owners themselves may be a lot more amenable to new proposals, new investors, and also sort of reorganizing their own businesses to focus on essentials. So that might drive a certain amount of activity. The mood amongst the people would also be, you know, everyone's got cautious. And I think you probably find that savings is coming, you know, whether you like it or not, consumption is going to fall because there is only so much you can consume and your movements are restricted and options are limited, right? So that could also drive savings. And even their mindset could drive savings. Now, does it flow into the stock market? Probably not at the start. You know, it's going into safety. But there comes a point when, the fear recedes. And fear recedes because certain factors have improved in the market, or you've started getting used to it. You know, it becomes normalized. And then people start moving back into somewhat, at least slowly, gradually, into some of the risky assets. So I think that, and you have this pool of savings that will probably come out again. So so how can the capital markets evolve? Apart from some of these new, what we hadn't seen in the past, like, I mean, mergers, acquisitions, and reorganizations, that activity will come in. You'll probably see a lot of interest for, you know, your regular, maybe fixed income, maybe one area, particularly the less risky treasury bill areas, right? And but apart from that, I don't see too much that can change in our overall capital market system.
If I were to pose the same question to Vindhya, from a capital market perspective, what do you think? In which way do you think the capital markets, even from an operational perspective, to product development or the products which are offered by capital markets, do you think there will be a shift, or will there be a shift that could happen in the industry?
I fully agree with Ali in terms of what he said. I think mergers and acquisition activity will pick up in that sense. I think there will be a role in terms of private equity, where banks might not want to take on certain industries, and there might be, this might be where private equity space might want to step in, not maybe in terms of equity, but in terms of some other structured products. So in that sense, I think the market will evolve in such a way, because the risk-off attitude in terms of a lot of financial institutions might mean that it might leave a lot of other companies in a position where they're not able to really borrow or really expand or sustain the way that they want to. In terms of investors who are investing in the capital markets, I think there is something that you have to be cautious if you're thinking of investing in the markets as well. Say, for example, in equity, one of the things that, one of the buzzwords that are going around right now is EBITDA, right? Which is earnings before interest, tax, depreciation, and COVID. So it's something that you have to be a little cautious about and a little aware of, just because of the fact that the market has fallen 25%, and individually, you know, you have different stocks that have fallen more than that, 30%, 60%, doesn't necessarily mean that when you're looking at valuations, these stocks are right now cheap. So that's something that investors should be aware of, because pre-COVID earnings will be a little further away. Like Chetana was also mentioning on the same, alluding to the same thing. So for you to get back to your pre-COVID levels will take a bit of time. And within this time, there will be a lot of stress companies will have to go through, and a lot of their inefficiencies will be highlighted. So it's the companies that have efficiencies that will really, you know, shine. And a lot of spotlight will be put on companies with inefficiencies in terms of financial problems or things like that. So I think investors have to keep that in mind, looking at a post-COVID market. In terms of fixed income, I believe I'm fully with Ali. I think people are going to move towards lower risk assets. So definitely, if you're in the corporate debt space, you're going to move from the lower credit quality assets towards the higher credit quality assets, or towards government securities. So again, there you will see there will be a vacuum created in terms of a set of investors that are going to be left with lower alternative borrowing opportunities or financing opportunities.
Chetana, if I were to pose a question to you on fixed income and equity, so we've seen significant foreign selling on the fixed income or the bond side, where we've seen roughly about 80 billion foreign sales from the beginning of January, and we've seen net sales of about 5 billion rupees on the equity front. What kind of appetite do you see, do you expect from the foreigners in the next couple of months or the next 12 months or so?
I think here again, Udishan, you really have to sort of separate out the immediate near term and the slightly longer term, right? If we know for a fact that once the market opens, you're going to see a substantial outflow from the equity market, right? And we know this because if we look at, as Vinda mentioned, if you look at the sovereign bond markets, credit spreads, which which rise when risk increases, I mean, that's increased by 1,600 basis points, which is in itself a stress point. But also it is the highest amount by which spreads have increased compared to any other past crisis that we've had, such as the East terror attack or the constitutional crisis of 2018. Right? So we know for a fact that investors are perceiving Sri Lankan assets, even safe assets, like ISBs and government securities, which are typically considered safe, even those you see an outflow, right? So it's hardly surprising for us to sort of expect quite a substantial outflow once the market opens. And what you might be wondering what exactly is a substantial outflow, right? And the thing is, it's hard for us to say, but I will try to give you some sort of anchoring points for that, just to kind of put it in context. If you look at so up to date, that is from January 20 until markets closed on March 20th, we've already lost about 5 billion rupees, right? If you look at what happened immediately after the Easter terror attacks, about a month after the Easter terror attacks, we lost about 1 billion, right? In the third quarter of 2018, when we had a constitutional crisis, foreigners sold out about 17 billion of the Sri Lankan equity market, right? So you can expect that in the near term, in the next maybe this year even, you're going to see a substantial outflow from the equity market. What determines the longer term appetite really is going to be what has always determined the long term appetite for Sri Lankan equities, right? It's a combination of the general appetite for risky emerging and frontier market assets and what is happening in the Sri Lankan economy and in the Sri Lankan political space. So just to kind of give you some numbers there again, if we look at a good year for emerging and frontier market assets, which was 2017, you saw that for the Sri Lankan equity market, we saw about an inflow of about 18 billion, right? When the appetite for risky emerging and frontier market assets dried up in 2018, we saw an outflow of about 24 billion, right? So obviously that goes to show that the general appetite for emerging and frontier market assets will have an impact on the Sri Lankan equity market also. And similarly, when the Sri Lankan economy is doing better. So for example, in 2010-11, the economy was overheating quite substantially, and it was at that point that foreign investors sold out the most from Sri Lankan equities, and that was to the point of about 32 billion, an outflow of about 32 billion. Right? On the flip side, when the economy sort of started to stabilize and pick up, then you saw the foreign investors coming in and purchasing about 30 billion rupees of equity markets. Right? So my point being, in the long term, obviously, it is going to be some combination of what the general appetite for emerging frontier market assets will be and where we are on the political spectrum and where we are on the macroeconomic side. So I think those will be the determining factors going into the next couple of months.
Alastair, touching on those points, foreigners being a large part of our turnover, so accounting for about 45% over the last 2 to 3 years. The Colombo Stock Exchange has been closed for probably the last 38 to 40 days. How do you perceive the foreigners will look at this? And what are your thoughts on the market closure for the last 40 days?
Yeah, so I think we don't need to perceive. You know how I think the feedback coming in through the brokers as well as the pending orders, they have not been pleased, and that's just an understatement. Now, the reason as to why the pros and cons of closing the market, I've heard various things ranging from, people can't trade, it's not fair because people cannot settle and so forth. and to the other extreme saying, okay, so in other words, curfew actually make it impossible for the market to operate, and maybe others wondering whether this is something to do with trying to control, manage the fallout in share prices, right? Now, either way you look at it, it doesn't make sense because markets need to be open. I know they become very volatile. They can take a beating, but that's the definition of a listed market. That people come in with the idea that, you know, I can sell, I can. They know they have to take price hits, but they know that on a liquidity point of view that you can actually sell when you want to. And if you block that for a period as long as this, now I can understand again, you close it for a week, that's something people will probably, or there's a genuine operational problem, that is something that will be accepted or taken in their stride. But when it's been closed for this long, it's difficult. I can only assume that this can't go down well, particularly with foreign investors who are anyway heading for the exits.
If I could, if you could temporarily, if you all could, if the participants could kindly mute your mics, please. Yes, sir. Sorry, Alistair.
Yeah, sorry. No, so what I was saying is, so this was closed at a point when foreign investors were anyway heading to the exits, right? So you pretty much, they were heading out and you've closed the doors. It almost creates a stampede when it's about to open again. It'll be interesting to see how that goes when they do open. You could very well, again, given that you had 38 days to think about things, there's more information out there. There's that factor is a plus. You might make better, or at least there's more information to make an informed decision. But whether it's going to be a better decision is still not clear, because you might have more information. Whether that's adequate information is something to think about. I don't think so. So as a result, I think I feel, and leaving aside this short-term volatility or the recent price dips, the sharp price dips that you might face, I think the greatest damage that is done is the long-term reputation of the market. Now, just to give a parallel, I think Sri Lanka, when you take our sovereign debt record, so we've always boasted saying, and it's the right thing to do, that there has not been a default, and that is counted in the markets, right? You might have similar rated sovereigns, or you might have sovereigns that are similarly rated, but where the credit metrics are different, and that is because there's certain weight given to the fact that you have not defaulted. In a smaller way, if you have, so we have an illiquid market, which is inherently, and relative to other markets, it has been illiquid, but there are still foreign investors that have come in, taking a chance, saying, okay, fine, I can handle the volatility, but that, you know, this has been a dependable market in terms of being able to come in and get out in terms of settlement and trading and so forth. Now you've brought in another element or another dimension of uncertainty, right? And at a time when, like, okay, when they do start coming in, there'll be so much of choice out there as to which markets they want to pick. And hopefully this will fade from investors' memory over time, but I'm not sure how long that would, or I'm not sure how soon that would be. So in that sense, I think it was damaging to close this market.
Thanks, Alistair. Touching on the same topic, there's a question from the audience to you, Alistair. The question is, who would benefit from keeping the CSE closed continuously? Is it the asset management with companies with AUM-based fees, or investors with high margin trading facilities?
I think it's just speculation. We really wouldn't know. Yeah, for asset managers, keeping the market closed is, particularly in a volatile period like this, doesn't help, because you know when it opens, it's just a false facade, because you know when it opens, it's all hell let loose. So that's not going to help. And even for margin trading, unless you know you can sell when it's open, this doesn't help. It just makes matters worse. I think a more gradual, and the fall is steeper over a shorter period, whereas if it was trading, it tends to find its own pace and it will settle at, it will again find its own flow over time. Whereas now I think you've just brought in a new dimension where it becomes very, very volatile.
Vindhya, this question is over to you. It's from the audience. The question is, if Sri Lankan export revenue is to drop by 40 to 50%, what is the view on FX rates in the next 12 months? And are there 1 year forward rates visible in the market right now?
So in terms of a view for the next, I'm sorry, it said what, 12 months, is it?
Yeah, next 12 months.
I think it's highly likely that we'll see around a 10 to 15% depreciation further. So, but of course, it depends on what measures we take to counteract these impacts, how much we are able to renegotiate in terms of our existing debt commitments and things like that. In terms of the foreign exchange fall, because we do have at the moment about 7.5 billion in reserves, and this can also or will also be utilized in terms of financing or funding our external commitments. So, but given that our exports are going to soften, if we continue the same import trajectory, I do feel that exchange rate can depreciate further around about 10% over the next 12 months.
Okay. The next question is over to Chetana. The question is, what kind of recovery can we expect in the Sri Lankan economy? Is it going to be a V-shaped recovery, or is it going to be gradual in terms of the recovery process?
I think it's unlikely to be a V-shaped recovery. I know it's too soon to sort of say that, I mean, the COVID-19 pandemic is an evolving situation. It's difficult for economists or analysts to kind of make an accurate prediction on what the actual recovery would look like. But my point is that even prior to the COVID-19 pandemic, economic fundamentals were looking a little weak. GDP growth had fallen to one of its lowest values in history, right? And we have this, very tight fiscal space, and we have these huge external debt repayments. I know that for this year, it's been resolved more or less, or at least, there are planned fund streams coming in for this year. But, for the next 5 years, we still have an annual external debt repayment of about 4 billion. So my point is that even prior to the COVID-19 pandemic, we were having some pressures on the economic side. And so I think in that aspect, it's unlikely to be a V-shaped recovery. I would think it would be a far more gradual sort of recovery, which really kind of fundamentally depends on what we do in the next few months in terms of, the different policies that are implemented and how the economy recovers post the COVID-19 pandemic.
Alastair, from your perspective, do you think it's going to be a V-shaped recovery, or gradual? It will be a gradual process where it takes a longer time to recover? But what are your views on it?
Yeah, I agree with Chetana. I doubt it's going to be a V-shaped recovery. Because we, as an economy, I think we had several structural problems that had to be dealt with. And okay, there might have been a chance earlier that we could have dealt with it, provided there was the mindset and the willingness to deal with it. We might have been able to deal with it as the economy moved, but now I think it's facing us head on. Along with these other COVID implications. Therefore, it's very unlikely to be a V-shaped recovery. Having said that, so there is an economic recovery, since we are about capital markets. So there's an economic recovery as well as there's a recovery in capital markets. And the two are not necessarily, they sort of synchronize, but there is time lags between, when one moves as, the capital markets are always will move ahead of, could move ahead of economic recovery. And if we've got beaten down, you were anyway trading at huge discounts, and you get beaten down further. And then when there are signs that the policymakers and the government are getting things together, and maybe it's a little bit more focused. So you can have a capital market recovery from the bottom of a trough that leads an economic recovery.
Okay. My next question is over to you, Vindya. This is from one of our clients, one of our audience here. So the question is, to what extent do you think the money printing currently happening now will have an impact on inflation?
I think, so in terms of money printing, there's about, I think central bank holdings have gone up to about close to 300 billion. So we've seen overall from about 70 odd billion, it's gone up by another 300. Right. So there has been a lot of money printing that has happened because central bank has been trying to inject liquidity into the market in terms of maintaining low rates and facilitating that low interest rate environment. Money printing certainly will, I believe, lead to inflation. But the thing is, it is based on it. There are a few caveats in terms of private sector credit growth, no matter what, I think will still be quite soft. So if you are not going to see this being translated, I don't think you'll see the impacts very soon. So in that sense, you might have time again to recover from where you are, depending on how the economy is progressing.
Chetana, if you were to add on whether this whole money printing right now is going to be inflationary in the near term, what are your thoughts?
Well, you also need to, like Vindya pointed out, you need to have higher credit demand, and that's not likely to pick up in the near term, right? So in that aspect, I don't think it'll necessarily translate to higher inflation, just simply because of the credit demand impact and the fact that that's going to remain weak for a little while, even once we come out of the pandemic. It's probably going to take a little time to recover.
Alastair, so one of the questions that the audience asking is, shouldn't the new opportunities that we pointed out in terms of PICMI doing well, certain segments of the economy doing well, do you need to look at these opportunities with a pinch of salt? And given that things like PICMI deliveries and protective equipment for the garment industries are more short-term fixes than more long-term fixes.
Yeah, so I think that is something we always have to keep in mind. Right now, we're in the thick of this pandemic, and people are making, so you have to make short-term decisions to manage or tide over till you get to the other side. But now, whereas some of these sectors are temporarily affected, right? And therefore, if your valuations come when you're looking at equities, you probably need to look at something to 3 to 5 years or even longer for that matter, right? Depends. Each investor has a different horizon. So when you're looking at a 3 to 5 year horizon, and you take your worst case and say, fine, this pandemic is going to get one way or the other. We'll come to terms with it in, say, the next 24 months. Some of these prices, the bottom of the market will be within this period. And like I mentioned earlier, the capital markets will start once it's clear what is the path to recovery. Once those signs are starting to become clearer, I think asset prices will start reacting to that.
Okay.
So you need to keep your eyes open all the time, and I wouldn't say discount write off markets. You cannot write off markets and forget about it for the next 2 years.
Okay. The next question is to you, Vindya. So there are fears of liquidity risk, especially from banking side or in terms of the non-bank financial institutions. From your perspective, do you think there is a real risk of default risk? And if that was the case, what kind of knock-on effects will it have on the financial sector overall?
In terms of financial institutions? Default risk in terms of financial institutions?
Yeah.
Yes, so I think there will be, in terms of financial institutions, definitely there is a high risk. There is a high probability that they will go through some stress, and I'm not talking about obviously all institutions. And even within financial institutions, you have to take into fact that you're looking at the smaller sized financial institutions with lower capital base and lower ability to weather the storm. One of the problems that these institutions will face is that investors will move from higher risk assets to lower risk assets. So that will see some deposit flows moving out of these institutions. And in this regard, these institutions have taken proactive measures. And I'm saying this because we see a lot of deal flows when it happens. There are inquiries in terms of whether we are interested or not to invest. And we are seeing that proactively these institutions have started to come and look at alternative means of financing themselves so that they are ready and liquid to be able to provide liquidity to depositors as and when they come. So in terms of, you're seeing like more securitizations that are being offered in the market, and so on and so forth. Unlisted debentures is another one that's coming, being offered. So these are some of the other instruments that are there. But nonetheless, I think the smaller institutions will see stress. Whether that will necessarily convert or translate to default is a different thing. Because I don't think the central bank also will allow a default in the short term. I'm not talking about the long term, but in the short term, the central bank, I don't believe, it's my opinion, that they will allow a default because there are a lot of measures that have been taken by them, right? In terms of giving moratoriums and asking investors' interest not be charged and things like that. So if the cash flow problems or the cash flow shortfalls are stemming from impacts that the central bank has given or directions that the central bank has given, I don't think that will be something that the central bank will then allow a default to happen or a problem to happen because of that. But what I do think in the long term is, because this is a short-term problem or a short-term thing that the central bank has done in terms of giving a 6-month moratorium and whatnot, and then you might not be recognizing the NPLs and so on and so forth. But in the longer term, these might translate to real problems for small institutions. So while I don't think in the shorter term, even on the regulator's perspective, they will facilitate as much as possible in terms of making sure that there are no defaults. But inefficient institutions in the longer term might not be able to recover the hit that they're taking on now. So it's the longer term that I think you need to be worried on a little bit more in terms of the small institutions than the shorter term.
The next question is to you, Chetana. In terms of the measures that the central bank and the government has taken up to now, do you think the measures taken were sufficient to manage the current economic context in Sri Lanka?
I think, Udishan, you can hear me, right?
Yeah.
Yeah, okay. I think, Udishan, the measures that were taken, they were taken, I mean, you have to understand that they were coming anyway from a difficult situation. Like I said before, the fiscal space was very limited, really. So for them to have taken certain measures on that end, or even for the central bank to step in quite aggressively and introduce the loan moratoriums and reduce the rates, the central bank, monetary policy wise, we had a little bit more space. I would say that, because rates were accommodative globally and because, in that aspect, there was some space on the monetary side, but certainly on the fiscal side, there has not been enough. I mean, they're coming from a difficult situation, right? So I don't know how we can expect them to do even more at this stage. It's like they're in between a rock and a tight space, like what do you do? What more can you do when your resources are quite, constrained in terms of resources? We are not like a US or a Germany where you can just sort of pump in trillions and trillions into the market. So in that aspect, I think what they have done is is at the moment at least sufficient. I mean, there could be more, but I don't know how they will manage to or afford to do more than that.
The next question is to Alastair. So SCC has introduced new circuit breakers for S&P SL20. Will that put brakes on market performances?
Market performances as to how the market performs on an ongoing basis? No, I don't think so. I think these circuit breakers are meant when to deal with situations when the markets are very, very volatile, and you give it a breather and let things settle down and come back in. Now, interestingly, they have introduced it at this point, which it's something we didn't have before. And it will get tested in an extremely volatile environment when the market opens. But I think so at the start, if there's a rush to get out, this will delay things further, and it might creates a sense of frantic selling, and every time the circuit breaker triggers, you'll have time for people to get more agitated about it. But I think that's just a day or two, and once that settles out, that'll get cleared out, and then it's just part of a regulation that can get operated in the future, which it shouldn't make a difference either way.
Okay. One final question. This is for both Vindhya and Alastair. Given the current uncertain environments in the markets right now, as asset managers or investment managers, how would you tilt your asset allocation in the current economic context?
Should I go first, Alastair?
Yeah, go ahead.
Okay, so I think in terms of asset management, we believe cash is king, right? In an environment like this, where there is such a lot of uncertainty going on, we fundamentally think that we need liquidity and we need flexibility to be able to change around our portfolio allocations or buy the securities we want to at the right point in time. So we, most of in terms of our institution, we started cutting portfolio allocations mid-February. So we are mostly in cash. And I think that is important for investors, because what we do believe is you will have opportunities. It's simply that you need to be ready for those opportunities. And whether the opportunities come now or you have to hold on for a little bit longer, that opportunity cost will pay off in the long run.
Okay. Alastair, your thoughts?
Yeah, so I agree with the part on, like I said even earlier, I think there will be opportunities, and you need to keep watching it. So we've been hit by this. If you've got out, fine. If you haven't got out, you have to take a call now. Are you going to still sell? It's dropped 20%, 25%. Does it make sense selling if it's going to fall another 20%? And what's going to happen at the start is that the price falls will happen in very thin volume. So it's an individual investors can take a call, whereas sometimes if you have a bigger position to unwind, it's practically not possible. By the time you've even started, I think you probably hit levels where you think maybe you should be looking at sort of reevaluating the whole position. But having said that, yes, if you can build in flexibility into your portfolio now, where you can pick and choose the moments where you want to buy, that would be the ideal position to create. And if you are an adequately long-term investor, and you also have, and even if there may be investors out there who have, for whatever reason, have not been in markets, and they might see prices that you haven't seen in a very, very long time, right? And I come back to the pandemic. It's something that will get resolved, or we'll come to terms with, and then life moves on. And we've seen you had these pandemics in the past, and interestingly, when you look at it, you find that how they dealt with it, because when you didn't have your how you dealt with it when you didn't know what you were dealing with was very similar, right? Whether it was in 1918 or whether it's in 2020, it's restricting mobility, mass, and it's the same game plan that you're adapting now, but you do come out of it. So I think what you'll have to do is, if you can get into cash or you've got into cash, all well and good. If not, you're not. Next looking at is, where are you looking at? So once you're looking for that point where the market troughs and you can probably deploy again.
Okay. I think we've run short of time. We have a ton of questions coming through, but unfortunately we'll have to wind up the session. Thank you very much, Alistair, Chaitanya, and India, been there for quite insightful session in terms of providing an outlook, as well as feeding us in terms of view in terms of how capital markets will look at in the next 12 to 18 months. So thank you very much for the valuable insights, and we hope to see everyone soon in another webinar series of us. So thank you very much. Hope to see you soon.
Thank you.
Thanks.
Thank you. Thanks.